Today, I'd like to spend a few minutes discussing two important developments that are shaping the current investment landscape: the Federal Reserve's decision to leave interest rates unchanged and the latest report on economic growth. Taken together, these reports help explain why markets continue to balance optimism about economic resilience with concerns about inflation and interest rates. Let's start with the Federal Reserve. At its July meeting, the Fed chose to keep the federal funds rate unchanged at a range of 3.5% to 3.75%. While inflation remains above the Fed's target, policymakers decided that current conditions did not yet warrant another rate increase. The Fed is facing a complicated balancing act. On one hand, inflation remains elevated, partly due to higher energy prices and continued investment activity related to artificial intelligence and data center expansion. On the other hand, the labor market has shown signs of slowing. June payroll growth was only 57,000 jobs, suggesting that economic momentum may be moderating. The Fed must weigh the risk of doing too much against the risk of doing too little. Rising rates further could place additional pressure on economic growth and employment, while keeping rates unchanged could allow inflation to remain elevated longer than desired. Adding to the uncertainty is a shift in Fed communication. Under Chairman Kevin Warsh, the Fed has taken a less transparent approach regarding future policy decisions. Rather than providing detailed forward guidance about what might come next, policymakers are placing greater emphasis on making decisions meeting by meeting as new data becomes available. However, there was an important signal in the July decision. 3 Fed officials dissented and favored raising rates immediately. While the majority voted to hold steady, those dissenting votes suggest there remains significant concern about inflation within the committee. The encouraging news is that inflation pressures have not yet become widespread across the economy. Core inflation increased 2.6% year over year, while supercore inflation, which excludes food, energy, and shelter, rose only 2.1% year over year in June. These figures suggest underlying inflation remains relatively contained, giving the Fed some flexibility and time to access incoming economic data. That brings us to the second major report, economic growth. The US economy grew at an annualized rate of 1.5% during the second quarter of 2026. While positive, that pace was slower than the 2.1% growth rate recorded in the first quarter and below economists' expectations of 2%. At first glance, slower growth may sound concerning, but when we look beneath the headline number, the economy continues to show important areas of strength. The biggest contributor was consumer spending. Consumers added 2.1 percentage points to overall GDP growth, reflecting continued confidence and spending activity. Personal consumption expenditures rose 0.4% in June, with much of that increase driven by spending on services such as travel, healthcare, and entertainment rather than goods. Business investment also remained positive, contributing 0.5 percentage points to GDP growth. While investment was slower than in the previous quarter, companies continued to spend on growth initiatives. Notably, some of the ongoing investments in AI infrastructure and data centers may not yet be fully reflected in the GDP data. There were also areas that weighed on growth. Government spending slightly reduced GDP growth by 0.1 percentage points. Part of this was due to sales from the Strategic Petroleum Reserve, a technical factor that reduces the government's measured contribution to GDP. Trade was a larger drag, reducing growth by approximately 1 percentage point because imports exceeded exports during the quarter. Importantly, the effects of the recently announced tariffs were not yet reflected in this report. When we combine these two stories, a clear picture emerges. The economy is still growing, consumers are still spending, and business investment remains positive. At the same time, growth has slowed somewhat. Inflation remains above target, and policymakers are proceeding cautiously. This helps explain why the Fed chose to leave rates unchanged despite persistent inflation. The economy is not weak enough to justify rate cuts, but inflation data has not yet deteriorated enough to force immediate rate hikes. For investors, the key takeaway is that today's environment continues to be characterized by moderation rather than extremes. Economic growth is slower but positive, inflation is elevated but not accelerating broadly, and the Fed remains focused on balancing both risks. As always, periods like these can create short-term market volatility. However, history shows that successful investing is typically driven by maintaining a long-term perspective rather than reacting to individual economic reports or Fed announcements.